The housing market, despite rising interest rates, is still experiencing rising prices in many parts of Canada. Many analysts have started to ask some questions about the sustainability of this trend and if Canadians can, in fact, sustain continued rising home prices. At the same time, some analysts and finance professionals have said that the Canadian housing market is at a tipping point. And our next guest has even suggested that Canada could be sitting on the largest housing bubble of all time. Joining us now is Phillip Colmar, Managing Partner and Global Strategist at MRB Partners. Phillip, thank you so much for joining us today.
Thank you for having me.
Your statement that Canada could be sitting on the largest housing bubble of all time has made headlines across the country. What are the main factors at play here?
Certainly is a headline. The key here is Canada does have an affordability crisis, as we all sort of know here. We've had a run up in house prices for call it 20 years. But the real alarming part was before the pandemic, Canadians got seduced into very low interest rates for a very long period of time. They took on a lot of leverage. So when you're dealing with excessive house prices, sting comes, and then obviously a tremendous amount of debt underneath the surface and mortgage rates start to rise, that's when the risk factors start to narrow in.
In terms of rising interest rates, is it quite possible that the Bank of Canada could increase rates again this month? In your view, would that put the Canadian housing market at a tipping point, or would rates have to continue to rise to pop the bubble?
We're already seeing the affordability problems right across the country and many home buyers. So anything that pushes up mortgage rates at this point is going to be problematic. We saw that in 2022, where we saw mortgage rates really rise substantially. Unfortunately, a lot of Canadian homeowners refinanced at or adopted short-term floating rates mortgages before the pandemic. So they really got penalized. As you know, Canada has a 5-year rollover system, unlike the United States, and a certain percentage of that gets squeezed every year. So anything that pushes up mortgage rates at these kind of unaffordable levels really is a problem. And we saw house price softness last year associated with that. There's a risk here that bond yields or mortgage rates go higher, and we do tip it in. I think that's the nearest term risk. Yes.
So, when people hear the words housing bubble, they might immediately think, like you said, of the 2008 housing bubble in the United States. In your view, what is similar to the 2008 housing crisis and what is different?
The speculation in Canadian housing is very similar to what we saw in 2008 in the United States. The house price run-ups and investment properties and people looking to buy them to either flip or as investments, that's very similar. There's some structural elements of the debt market that may be slightly different. The concerning part, though, for me is that household debt to income ratios have vastly outstripped what the US was at its peak. So that's where it came into maybe one of the largest housing bubbles ever, the most concerning ones ever, is the fact that we're probably 30 or 40 percentage points higher in debt to income ratios than the US did. So Canadians are making Americans look fairly prudent at the peak of their housing bust. Now, what's different is that Canada is not sitting on one of the biggest consumer bases in the world and have a world reserve currency. So the adjustment mechanism, if there was a burst, would be quite different. You'd see house prices fall. You'd also see the Canadian dollar fall with it. Foreigners are already interested in Canadian housing. They certainly come back in more if we saw a major haircut in Canadian housing and currency off. But I think for Canadians, that's a problem because your foreign purchasing power gets hurt. It is part of the reflationary mechanism to get yourself out of a crisis is you export to a solid US economy with a lower currency. So that's a benefit and may cushion some of the recession, but it is a consequence that you'll end up absorbing.
Now, some analysts have pointed out that limited housing supply in Canada and increased immigration levels could potentially delay or even stop a housing bubble from occurring. Do you agree with that view?
I think that you have to be very careful with the data. So you do see limited supply currently, or housing completions are very low at the moment, and historically low. And so I think that that's one encouraging sign. The problem with it is there's a tremendous amount of housing under construction that more than dwarfs that. So if you look at one side of the data and say, well, there's not a lot of inventory today, well, that may be true, but over the next 2 years, there's a ton of it coming on. There's a lot of construction projects, particularly condos, all that kind of stuff coming on. It's at record highs and it looks like it's bending back on a chart almost. So that's very problematic in terms of the supply. I wouldn't be comforted so much in low inventories. The immigration issue is an interesting one in the sense that you have new demand coming on. But the key is are those immigrants coming in? Are they millionaires or wealthy? The next million people coming in able to buy housing at this price? Are they going to get jobs that afford them a better income than Canadians are currently earning so that affordability of that house isn't so excessive? Or is the Canadian government or Canadians willing to subsidize them to purchase a house? I don't think all of those things are really probable. So, yes, the demand issue may be an issue or may be encouraging, and they may want homes, but can they really afford them? And is there enough jobs to supply for these immigrants to be able to buy them? And if not, then we have a problem.
We definitely have a problem. Thank you so much for your time.
Thank you for having me.